Investing can either make you rich or leave you regretting your decisions. And the truth is, most people make one or more mistakes that cost them big, whether it's losing out on your gains or risking everything. Hi everybody, my name is Samesh Rajpal and welcome back to my YouTube channel where we help you to take control of your financial future and mental well-being. In this video, I will be sharing critical investment mistakes that could ruin your financial future. Avoiding them could be the difference between building wealth and watching it slip away. So, without further ado, let's get started. Number 1. Putting all the money in highest return assets. This notion is often called as alpha chasing. Alpha and beta are one of the fundamental concepts of stock markets. Alpha refers to how much you are earning more than the benchmark, or you can say by how much you are beating the benchmark. Like for equity mutual funds, the benchmark is mostly Nifty 50 or Sensex 30, whereas beta is a way to gauge how risky the investment is or how much volatile the investment is. Generally, a new investor runs only after alpha as they only see growth or profits and start chasing it, while ignoring the beta, that is the risk associated with the investment. For example, as of 2024, small cap mutual funds are on fire. Almost every small cap mutual fund is giving a return of 30%, 45% or even 50% in a single year, and people have gone crazy by seeing these kind of returns and are investing heavily in small caps. But they have forgotten the fact that small cap is one of the highest risk asset in stock markets. As small cap companies are volatile, even a small event like inflation number comes out to be more than expected, or some taxation issues pops up in the company, or some new ruling comes out, etc. Small cap industry will be the first that gets crashed. Now, if all or majority of your investments are in small caps or some high risk asset, what are you doing essentially is that, my friend, you are sitting on a nuclear bomb which can explode anytime. What's the point in doing all this? Simply just follow one simple rule: 100 minus x. Basically, it says assume this x to be your current age, and whatever the figure you get after deducting your age from 100, only that much portion of your investments should be invested in stock markets. Even with this amount that you are investing in markets should be diversified by allocating some amount to large cap, mid cap or flexi cap and small cap. By doing this, you would not be only going after alpha, also optimizing for beta as well. Number 2. Doing over diversification. These days, people do invest in mutual fund. Well, that's good. But the other side to this is that people generally invest in like 10 to 12 mutual fund schemes, doing SIP ranging from 500 to 1000 in each of them. Bro, let me tell you, ज़्यादा mutual fund schemes ज़्यादा return नहीं देती हैं. Then what are you optimizing for? Basically, here you are optimizing for fear, as you don't know which mutual fund scheme is good for you. As a result, what you end up doing is कि जिसने जो suggest किया वो सब ले लिया. Even these days, people invest in mutual funds as if they are doing shopping based on scheme names. Energy भी ले लो, infra भी ले लो, pharma भी ले लो, opportunity भी ले लो, etc. सब कुछ ले लो, and you will just keep on buying various schemes and don't bother to see which companies are these mutual fund schemes eventually investing in. There is a high probability that in some mutual fund schemes में आपको almost same companies ही मिलेंगी. हाँ, weight might be different in each scheme, but companies would be same if they are based on same category or theme. Basically, the point here is that you do not need a lot of mutual fund schemes. Only 3 mutual fund schemes are required to build a healthy portfolio. One would be a large cap, one could be mid cap or flexi cap, and one would be small cap. But the ratio in which you would be investing in these schemes will depend upon your risk appetite. Example, if you are young and don't have much responsibilities and can take risk, you can consider investing 30 to 40% of your stock market portfolio in large cap stocks, 30 to 40% in mid cap, and 30 to 40% in small caps. Whereas if you do not have risk appetite or you are in your late 30s or 40s, then you should invest 60 to 65% of your stock market portfolio in large caps, 20 to 30% in mid cap or flexi cap, and balance portfolio in small caps. Essentially, the risk is what you are managing. The portfolio will not be overly diversified and still you will be earning a reasonable return. This is not just limited to stocks only. Most people, when they start investing, they think they should invest in gold, real estate, PPF, EPF, insurance, or even they would be considering taking a top up on some investment, etc. See guys, all of this is just because of your lack of understanding or lack of confidence. If you are clear on how much risk you can take and how much return is sufficient for you, you should not overly diversify. Do only some investments, that too passively. Just invest and forget. Number 3. Believing that any specific investment is 100% safe. No investment is 100% safe. Even your bank FD is not 100% safe. FD is undoubtedly safest, but still there are scenarios like bank can go down or bank can run away. What are these? You can simply Google and read more about them. Whole point is that even your bank FD can also be lost in some situations, and insurance is only up to rupees 5 lakh. On other hand, stock market investment is never safe as it is subject to market risk. If the market is up, you tend to believe that you know everything, I am the boss. Whereas on the other hand, if markets are down, you would be thinking, what is this happening? I shouldn't have invested in this. Both the approaches are wrong. Every asset that you invest in has an alpha and a beta associated to it. That is, it has a growth as well as risk associated to it. It is most important that you understand both. Number 4. Not having clear investment goals. As it is said, if you do not know where you are going, you will probably end up somewhere else. This is true for investing as well. Everything from investment plan to strategies used, the portfolio design, and even the individual securities that you would be selecting for the portfolio can be configured with your life objectives in mind. Like you are investing for your child higher education or your child marriage, or you are looking to buy a house in near future, or whatever your objective with the investment is. Many investors focus on the latest investment fad or even maximizing short-term investment returns instead of designing an investment portfolio that has high probability of achieving their long-term investment objectives. To recap, here are 4 critical investment mistakes that you must avoid while you are starting out with your investing journey. Number 1. Investing all of your money or majority of your money in highest return assets. Basically, you don't go after chasing only alpha. Rather, optimize for beta as well. Number 2. Do not over diversify your portfolio, as too much diversification doesn't lead to higher returns. Number 3. No investment is 100% safe. You just need to understand your risk appetite and managing your portfolio according to that. Number 4. Not having a clear investment objective. I hope you won't be making any of these critical investment mistakes and you would be investing your money wisely and taking informed decisions. If you are new to my channel and like these kind of videos, kindly consider subscribing to my channel, liking the video and sharing it with your friends. That said, I will see you in the next video. Signing off, Samesh Rajpal.